Okay, so it looks like Bitcoin. Well, we're ready to ramp up, aren't we? Let's be frank. We have some really interesting data coming out today. We've had some interesting data already, actually, for unemployment, ADP, and so now we're just anticipating what comes next. This is really just about getting prepped and prepared so that we know, irrespective of how the move or the data comes in, we've got a plan. And that's what we're going to kind of try to go over. All it's about, all trading's actually about, is just confluence and how to react when we hit certain levels. So let's just, what do we want to start on? We'll start on maybe the 2 hour. Let's see where we are. So as you guys will probably know, let me bring the volume in actually. We haven't really seen too much by way of anything actually since we've been trading yesterday. I think everyone's probably just a little bit nervous. You can see, as we see the information here, we've virtually broke any of these key levels. If we bring on our high-term time frames, you can see, what are we on the 2 hour time frame right now? You can see very literally we've just stayed kind of in between, your monthly key term time frame and also your daily. So don't have any significance, or we've had no significance in terms of a move. And again, that you can tell the volume. If I look at that volume, it's continuously kind of dropped to the downside, so you don't really see too much by way of motion. So what follows periods of low volume? Blast out periods of high volume. So I'm anticipating we're going to see some fireworks. Now look, it's not necessarily fireworks by virtue of the price will moon or the price will drop. Actually, we might see the price moon up and down, but ultimately get back into a range. The idea of how the markets like to move. It's all based around this narrative of trapping traders to one side, going long. Everyone dives in at the end, and then price reverses, comes back down, and again traders get trapped to the downside. So it's the favorite move of market makers. Right, so let's look at what we've got. So just zooming out a little bit. One of the things that I've been kind of monitoring for a while now, kind of since late November, is the crab harmonic. So this pattern here, well, let me just take that off really quick. You can see, we come down, come back up. It's almost like a W kind of sense, and then we kind of that's a very, very bearish pattern in that sense. You can get obviously the ones to the upside, which are inverted versions of this, kind of like that. And then again, what you're looking for is the point at which it breaks back to the upside. So what you ideally want and what your aim is that you want your 1.618 in between your X and D as the, let's say, the point of resolve, the point at which this information resolves, and the price it's to that point. So I've got this on my chart as one significant area. So an area of significance in terms of, if price breaks to the upside, what will that mean in terms of where that, what will we do at that point? How will we respect that level as an example? So the first thing I want to try to see is, have we got any confluence around, the resolution of this price here? You can see it's roughly around your 25,200 area. Obviously we'd be trading above that channel, but you can start straight away. You can see, if we look at liquidity levels, let's just say, so where on the chart do we see high liquidity areas or zones where there's going to be a lot of liquidity traded? Well, for a start, anywhere where you find a point on the chart where we haven't come and tested in a long time. You can see here, this was the high of that drop before it came back down. We know there's going to be a lot of liquidity there. You can see all of the people who'd been longing. So any longers at this point, anyone who's gone short at this point here, you're going to find that area all along this line here is going to be full of liquidity for people who have been shorting the market at this stage here. So you're going to find liquidity there. Obviously, in this kind of tight range we're in now, or the top of the channel, we're going to find liquidity above here. simply because again it's the local high point, and we haven't breached this, for since I would say August 22, so quite some months ago. So you're going to find a lot of liquidity there. Now we do have an interesting tool that allows us to identify where liquidity are and where potential liquidity zones would lie. Now you can see obviously we mapped out above this area, whether it's 25x leverage or 50x leverage. We can see works better on shorter time frames if you go into higher liquidity levels, but you can see all above here we're kind of here now. I know it's difficult to see the parallel channel where I'm at, but you can see this is the top of the parallel channel just here, and you can see all of the liquidity up and around there, and just above where that channel is. So nice nice way to map out, almost like gives you an overview of high block mixed into trading view, which I think is a nice way to see where that liquidity is. And the other thing I quite like about this is it will, if we break through a liquidity zone where these liquidations are, this is what these are effectively, liquidations. Whether the, I think I've currently got my settings at 25x, and I've got two different settings. One that shows liquidation levels at 25x, and the other ones that will show liquidation levels at 50x. So what I'm looking for is, the aggressive kind of quick in, quick out guys who want to try and make a quick buck, and obviously that's what market makers like to do. They like to find where the liquidation levels are, because that's just an automated move where central exchanges will convert a buy into a sell and a sell into a buy, depending on whether you're long or short. So always good to kind of get a sense on where they are. But again, from a confluence perspective, you can see that 618 lines perfectly with that liquidity zone. So, going back to my 2 hour, I am going to be monitoring that quite intently, with an idea that, if we do come up to this zone, I might look to short. Of course, what I'm going to be looking to do, more importantly, is not just short, but look how we react to the zone. So, what I always like, I mean, I don't know if you're familiar with Trading Light, but it's a fantastic tool that kind of gives you an indication on what's going on in the market, and being able to map out how reactions occur. So you can see, just going to delete that. This at the bottom here is the what would you call this? This is the open interest. So open interest you can think of is money leaving or entering the exchange. So leaving the exchange can be done through a number of ways. It can leave via people taking profits. It can leave via liquidations. It can leave any way where money can come out of the exchange. Stop losses is another example, and obviously money coming into the market is clearly where new retail money is coming in, favouring buys or longs or shorts or whatever it would be. Some money coming back into the market, and it's usually a good way to identify like this. You clearly here, I mean, just as an example of how you would view open interest, is you can see here we have this big long candle. Let me just zoom in here so it becomes a bit clearer. You can see we have this candle here, which went from 23,136 right the way down to 22,557, so about a 700 basis point move. And where does it go to? Right into the liquidity. These are basically limit orders that are sitting on the order book. So passive orders, not aggressive. I guess aggressive being market orders, passive being limit orders. People who are just happy to sit on the order book and wait for their position to get filled. So oftentimes when market makers see where there's a lot of liquidity, they will push price down to that place so that they get filled. A lot of liquidity means you can transact a lot of money going to and from that exchange. So how do we realize what happened there? Well, you can see open interest dropped. That means a lot of money left that market, whether it was profit taken, for people taking profit when it hit to this point, or whether that's just liquidations. You can see here. Now, what I do know is that it was actually liquidations. Why? Because, you can see quite clearly actually that these are all the people who've got absolutely wrecked. And so, yeah, these are just people who have been longing, and long liquidations have occurred. But what I like about this tool is when you are approaching, let's say, an area of value or a zone that you think you expect a reversal, the things you want to look for is how, why did we reverse this zone? specifically. Look, if you look at that candle, you can see limit orders were being built many hours before. So, the order book was getting full. Of course, price was some way off this zone, but price comes down, and that's, these are 15-minute candles, so that would have been a fast acting move to the downside. Now, if you've got a buy order there, you can see open interest drops from liquidations, but the CVD, which is now a new thing that we'll talk about, which is pressure. So red is essentially meaning negative pressure, or more people selling, as a delta. So if you think delta neutral being 0 at any one point, depends on where that anchor point is, but at a point at which you measure, are there more buyers or are there more sellers in the market? Now that will determine whether the CVD is aggregated towards negative or delta. Cells, as in there's more cells in them going on at this state, that this time frame to the anchored point than buyers. So it would give you an idea to say, okay, well, if there's more sellers than buyers, I would expect the price to go down. Well, this is the problem. So you see, each one of these is a 15-minute candle. So we hit the bottom here. Okay, the bottom, you can see, hits here. But actually, to move this on, you can see that the bottom actually continued to go a little bit lower. So that's almost like a continuation of that low. But what happens on the open interest? Okay, I'm just going to make this a little bit more pronounced. So you can see on the same candle, open interest, comes down. That would ring true for this move to the downside. But then open interest comes up, meaning money comes back into the exchange, or more positive money's coming into the exchange. But actually, CVD remains low, but price reverses and goes back up. Why? I don't understand. I do understand, but you might think I don't understand why this is the case. So there is more sells occurring than buys, but actually it's not strictly true. What it's actually suggesting is aggressive orders. So there's more market orders buying at that point. So think about it. You have limit orders and you have market orders. Market orders are people who will just trigger an order, pay the spread, and they will just they'll pay at market value. Limit orders will ask a specific value. It'll be I don't want my order filled until that order, until the price hits that level. And that's exactly what this yellow line is here. So you can see, the price has come down, a lot of aggression, hit the zone, and then we've basically the price is reversed. But the market, so the guys who, and usually this is purely retail based, because you can tell the retail sellers are still trying to push the price down, because they've probably caught a fallen knife, so they've got on the bottom of the move, lots and lots of sells. Big player absorbs those market orders, price whips back to the other side, liquidity comes flying back into the market. You can see it here, open interest comes flying back in on this US BTC USDT pair, and then price reverses. So I always think to myself, when you're looking at TradingView as an example, it's a really good tool, because it allows you to, make your TA, but it's very subjective, right? It's your version of how you think, in your opinion, with a lot of different noise, lots of indicators, lots of stuff like that. And it's the same for everything, by the way. I'm not necessarily saying that trading light is any different. It's all about interpretation at the end of the day. But what you're trying to do is, if you're day trading or even swing trading, you're more focused on, bit more macro. What's the fundamentals? Is there anything that's going to change or drive the main economic kind of data? Versus kind of day trading, you're more linked into what's the bias for the day. Where can I get in? Where can I get out? And that's why I think when you're trying to map out specific areas of interest or areas of value on a chart, what you're trying to do is come up with many areas of confluence. Now that can just be as simple as a level, it could just be simple as saying, okay, well, this is my level. This is a level that I'm going to trade in for no other reason that, maybe you could say, well, it's a fair value gap, right? You could say, well, maybe because we haven't come up and claimed this fair value gap here, right? Okay, it's a very, very fair assessment. Why not? It's just an idea, yeah? It's an idea that you think we may come up and this would be an area where you could target as a fair value gap. We've got some confluence, of course, in the same zone. We've got liquidity, and we've also got our crab harmonic finishing again right at that same point, giving us a perfect 1.618. That would be a lovely zone to reverse from, and you could say that why that would be the case. I would anticipate actually that usually price will probably slide past a little bit further than just ends in there, because when is it ever perfect, right? When is price or anything ever perfect? It isn't. So you've got to kind of give yourself a bit of a move. And again, the next movie we've got nice fair value gap. So let's just take some of these off the chart just to remove some of the kind of noise. Next one we want to kind of look at is pivot points, right? So this is the weekly pivot point. Now, interestingly enough, we've got a much wider pivot. So what this says is, okay, beginning of last week, this is the pivot point, but obviously we absolutely rocketed through. So that, 31st, I'll just check where we are on a week. No, this is the monthly pivot. Okay, let's stick to the monthly. It was a relatively tight. Well, the way pivot points works, it's based on calculations from the previous month's data. Okay, so this is because this is your pivot, this is your R5 kind of support resistance, and this is your R5 support, and each one of these iterations in between, and they're calculated based upon the previous candle. So the way you calculate your pivot points is you say, okay, well, what was the high and what was the low of my previous month candle, and what was the close, right? And then you divide that by 3, and that will give you obviously one value. So if you had like, I don't know, this was your candle, terrible candle, this was the high and this was the low, you would calculate the high, the low, and the close, and then you would divide the 3 values by 3, and that would be your pivot point. So then you take that value and then you'd map that value here, and the previous month's data, this is the pivot. So that's the pivot point. And then you work out your R1, R2, R3, I think something like by um, time, taking your pivot, timesing it by 2, and doing something else. Honestly, I can't really remember. I'm not really bothered about the calculation, but ultimately it was what was used for years, for all the traders on the trading floors when, fancy indicators and all that kind of stuff went out, and he wants to gauge a range where they could hypothetically expect to trade within, and that would be, you could have a daily pivot, a weekly pivot, a monthly pivot, and it's always stuck. It's always been a nice kind of gauge to work to. So this is a standard. This is just a standard indicator, and anyone could kind of pick these up and use. But it's interesting to think, we on a monthly pivot, yeah, we kind of rattled through and hovered around R4 and then rattled through again, and now our pivot is down here. So I think that's an interesting point on the chart, and I think R1 is also an interesting point on the chart, and actually I think S1 is also an interesting point on the chart, because if we map a horizontal line right on S1, which is your first support level, you're right at the peak of that crab harmonic pattern as well, actually, and also you can see here you've got a lot of confluence where we've had these touch points way back when, so it's just a lot of alignment, let's just say, where we can expect price to go. Now this is the monthly, literally at the start of a new month, so there's a lot of travel to happen before now and then, let's just say. So okay, so interesting, we have a pivot point there. Let me just see what else we have in terms of some pivot points. So we've got our channel, that's there like that. Okay, we've got our crab harmonic, as you can see, that's just starting the zone. Right, I'm going to delete them. I want to delete that. That was just our. Actually, we'll rename this, because this is a fair value gap. Okay. So what else do we have? Let me just take these things off the chart really quick. Take that off. So we want to just I mean, anyone who knows me knows I like my Fibonacci retracement tools, so we're going to use that actually. Let me just go into the 4 hour. Let's get a bit more movement. So let's take the fib and let's see where other interesting zones appear. So we have a couple of interesting points. So if I put my parallel channel back, now the parallel channel obviously is, you're just ranging, aren't you? We're taking the range that we've been working with over the past, week or something like that. And you can see, the 382 lines perfectly at just on that 21k, literally $2.50 short of 21k. So that's a really interesting one, right back into the consolidation zone of the previous one. And actually, one of the things that would be quite interesting actually is if we came back and then hit this zone, you've got yourself a head and shoulders pattern there as well, which would be just an interesting dynamic for any of my people who like to watch the patterns. But again, if we do come back into this zone, I'd be interested to see where this goes. From a more kind of smaller time frame, one of the things you can also anticipate that might happen is we come down, we see this kind of whip crack of the FOMC, and then we come down, claim the liquidity just at this 236, which is around that 22 150, 22 200 mark. There's also a lot of liquidity, down in this zone because number one, we're breaking the parallel channel. We come down, grab the liquidity, and then we could quite easily revert back into the channel. This is based upon the fact that it could be just a 25 basis point move. Ultimately, it's probably being priced in. Yes, you're going to get a lot of volatility, high moves left, right, and center. We could anticipate something like why not, hit that, hit the high, claim a bit of liquidity, come back down, retest the zone, and then come up and get that liquidity up here again, just bringing that back into where that would look like. You got, a lot of interesting reasons why. Let's see, was it that? Yeah, we could come in, test this zone, and then eventually come back down. I don't know why I draw so scruffily like that. That's not great, is it? Let me just give that a bit more credence. So, what was the other one? Item time frame. We've also got a weekly. I know we're getting a little bit messy right now, but we've got a weekly level right here at that 24,290. Again, it's above our channel. Another liquidity grab. However, for me personally, because we're starting to see such low volume, one of the things I'm really keen to and one of the things we tend to see is when volume starts to kind of decrease, you normally get a big move, one way or the other. So we shall see. One thing I would say, I mean, look, the volume here, you've got to, I think you'd probably agree, if we take the volume at this zone here against that zone, I mean, volume's been relatively high, since this really poor kind of time. But having said that, it was December, end of Christmas, and the areas when there probably wasn't, well, not a lot of institutional money anyway. So perhaps this volume is more akin to the norm rather than, just taking previous, a couple of months worth of data and suggesting that that's the point at which we want to benchmark against, because that's not really a fair indictment. I think it's probably more, you can, if you look at this volume, average volume here, it's more akin to kind of, this phase here, which was, beginning of December, and then you've got this phase here, which was obviously that was the FTX piece. So just some interesting things to keep in your purview. The other thing, just as well, I've not looked too far ahead in terms of where we are with. It's not that one. Trend. Just had that one up, haven't I? Fib extension time. So some interesting things is, if you take, I know this isn't necessarily prep for the FOMC, but if we take our low here, our high back to our pivot low, this was the FTX fallout. You can see, we first caught this 2,000 basis point move right at the top. What are you looking for? Whatever position the previous move is, you normally expect a move to the alternate direction. So you can see here, this was kind of catching the start of that huge move to the upside. This caught a lovely 2,000 basis point move to the downside. And this is based upon, if we just mark that out on the chart, we've got previous low, previous high, back down to pivot low, boom. We've got a nice move there, and then a nice move there. So that's kind of caught that move to that side. So it's going to be interesting to see. This, by the way, finishes at on the 10th of February. So mark that in your diaries. What else do we have? So yeah, well, if we think logically, right, let's look. We have whether you determined this was an ABC correction or whether this was an Elliott 5 wave. I mean, let me take my magnet tool off. We don't need to be too precise here. You can say, like, this would be 1, 2, 3, 4, and then 5. Theoretically, that is the end now, of a 5 wave move to the upside. And if we zoom in, what are we on the 4 hour? Let me go to the 15-minute actually. I think we see this a little bit clearer. When we do that, now what you're looking for is some sort of an ABC correction. Okay, so ABC, being a zigzag pattern in this case. I don't think at the moment anyway it looks like a flat ABC correction. I can tell that just because let me just fix this a little bit, bring this to here, because here's my ABC. So you can say, look, this should be A. This looks like we've topped out at B, and then C, is somewhere down here. But this is what we'd need to anticipate. But what your first thing you want to say is, if that's got any kind of leg, you want to see 5 waves within your first wave structure. Okay, so you're going to say, okay, well, if I take my ABC, it's 1, 2, nice move down for 3, 4, finish off for 5, and then it's a 3 wave. I can see here nicely we have 1, 2, 3, finishing off there for a A to B. I'll just map that out again just because I can. Kind of A, B, C. That was a little bit grim. And then it's like, okay, well, now we need to see some form of a move to the downside that was, 1, 2, 3, 4. Maybe not like that because that just looks terrible. But you know what I mean? It's like you want to see another 5 wave structure. So maybe that could be like, maybe this actually could be 1. So this would be your 1 move. This would be corrective, but you'd expect this to be an explosive move. So you'd want to see this kind of move a little bit more explosively, hit the 4 and then finish off for the 5, finishing our C wave somewhere down here. Obviously, I think we'll get a lot of flip-flopping. I mean, maybe actually, if you think logically about it, that the FOMC meeting might be the catalyst for a C wave on this kind of corrective ABC of that move, of the entire move, which would theoretically be, by the way, a nice move to resolve a lot of problems for us to then decide on, if we're going to continue back to the upside as a move to the upside, then, like I said before, I mean, I'm just going to remove all of this kind of fluff a minute, because one of the things I've never really been comfortable with is if this is, a wave, so that 1, 2, 3, right? It's like, okay, well, if I'm going to commit to suggesting that this is 1, this is 2, this is 3, and this is 4, and this is 5, it just really, that correction, it's not, and the tightness of that 4th wave is not really, something that is which you tend to see. So what we could perhaps think about is that this is the continuation actually of your, so there's 1, there's 2, 3, because what do you want to see in a 3 wave? On your 3rd wave, if anyone in the comments wants to want to guess if they can, but ultimately, you want to see a 5 waves, don't you? And so far I can see. So if this is our wave 1 here, I'd say that was probably wave 2. Let's say that is wave 3, wave 4, and then, a huge wave, well, not huge, but, a wave 5, maybe up there somewhere. I could get behind that idea a lot more simply because, I just looking at structure, let's try and figure it out. So you'd say, well, 1, 2, 3, 4, 5. There's 5 waves. 1, 2, 3. That's more of a flat ABC correction, yeah. And then you're going to say, well, we want to see 5 waves here. Okay, so huge wave 1, wave 2, tiny wave 3. Just doesn't seem to make sense. 4 and then a 5. Look, at the end of the day, by the way, when you're talking about Elliott waves, it's like, okay, well, is it invalid? What is it something that I'm in agreement with or disagreement with? It doesn't really matter if you agree or not, because it's going to play out whether you think it is or you don't think it is, because it's more about mass psychology. If enough people think, well, this is a C wave, sorry, if this is a 3 wave and they're waiting for the reversal, there's all that kind of stuff that goes on, but then market makers are anticipating what people like me, you, and everyday Joe as a retail trader are thinking, and are trying to set up the trap. So just be mindful. So what are we at now? It's currently, well, it's about an hour, I think, isn't it? About an hour before the FOMC. So nice quick one here. Wasn't really wanted too long, just to kind of give you some ideas about where price. I'm anticipating price to go. Obviously, as you know, we looked at this level here as a potential level. Was a liquidity. Yeah, so we're looking at kind of around this 25,200 as an interesting point. If we want to go a little bit higher, we can look at this fair value gap around at 26,200. If it wants to go that high, if we want to go lower, I would look at, let's see, we've got our Fibonacci. So again, we not nice and simple on this one, because we've got a lot of, it's much easier to look back where you've got previous reactions below. When you're getting higher, you've got to look at what's there. So you're looking at around this zone here. So you're around that 22k, 22,100, 22,200 as a way to again, I wouldn't be looking to get a long in there if the news comes out relatively bad. In fact, I'd probably be wanting to short if the news comes out bad pretty much instantaneously, but I'd be wanting to looking at taking profit around these zones. So you've got one around that 22, 100, 150, something like that. Then you're around that 21k, which is nicely in that kind of consolidation zone. If we overlay very quickly our volume zone, so these are essentially taken from the entire chart from its all-time high, right? So you take the all-time high, which would have been that point there, you slap on your profile, your visible range profile, and you put it on a daily, and then you see where those high peaks are. Pretty much every single one of my videos at some point has called out how to do that. What I've done is, rather than doing a line, I've done a zone, so covering a bit more of an area, because when is it ever a perfect line, right? Sometimes you want to look at the zones. In terms of the zones, though, these are the points of the chart where we get sticky, so where price tends to spend an awful lot of time. Why? Because bigger players like liquidity. They like to transact in zones where they can get money in and out of the exchange. So you often find, it's like, okay, well, we've got huge moves don't tend to start on or around liquidity to another zone. It's like, let's take huge move came down, we kind of came to the liquidity zone here, shot back up, and then we kind of right at this value area low. Again, we shoot back up away from that, come back down, retest the value area high. Sorry, not the value area low. Same again, and then that's acting as a line of support, that value area low. But then what happens, of course, huge fallout. I can't remember actually what caused this crash, because that's not the FTX one, is it? That's something else. But whatever that was this COVID? It was COVID, wasn't it? Am I right in thinking that? No, it wasn't COVID. Someone might be able to tell me what this was. I can't remember, but it was obviously a bad one. Point I'm trying to make is, you can see at the point at which we shoot through, we kind of solidify back against around these areas. So again, they're just areas on the chart that I like to just map out for more like swing trading. So trying to catch a wider trade, but certainly from a smaller time frame perspective, we've got the point of interest right at that 19,150, and then these kind of opaque white zones are really important points on the chart, on the visible range volume profile, that I've got, a lot of significant volume traded, and it's clear, you can see, we trade in and around these zones. But when we push past the zone, where do we go? Of course, we go to the next zone here. So I can also see, if the news comes out really bearish, then I would be looking to target at least this 21,500. If we come out at 50 basis points, I'm going to be looking, I'm already in a short, by the way, just for transparency. So I'd be looking for taking profits down at this zone, and then maybe seeing the reaction on trading lights, seeing how, open interest fares, see if we're getting a decorrelation to bearish divergence, or bullish divergence. It would be in the sense of open interest and CVD in correlation to the price. That's what I was trying to say. If the price is doing something different from CVD, then that indicates that there's bigger players absorbing that. And then you want to be thinking about either one, taking profit, or getting out, and maybe using that as your area for pivoting. So hopefully you guys enjoyed that. Looking forward to the FOMC, so we should see what it would be. I'm anticipating personally it'll be a 25 basis point hike with a really hawkish commentary after the fact, which again is just going to cause this whipsaw effect. So that's pretty much it, guys. So look, hopefully you enjoyed it. Please hit like, subscribe, all that kind of stuff if you got anything valuable in this. If you guys are looking to trade and follow along with us, come into our Discord server. I will add a link in the description. Apex Trades, we teach this stuff. I go over this all the time, and we do lots of kind of live sessions and whatnot. Cover the economic overviews for the landscape of understanding what the potential might look like for the fundamentals. If you are looking for a platform to trade, use Bybit. It's the one that I use. I also have a link for that, which I will put in the description. So if you want to use that, you will get I think $50 sign up bonus or something like that. Benefits you, benefits me, benefits the channel. What's wrong with that? Right. Anyway, I shall speak to you guys in the next one. Peace out.